All right. Good morning, good afternoon, everybody. Thank you for your time today. Thank you for joining us for our presentation on fiduciary training, plan operations today. A couple quick housekeeping items. If you have any questions, please just put them in the chat. We'll try to address them live rather than waiting. And there will be a recording of today's presentation sent out to you probably in a day or so. Just give us a little bit of time and we'll get it out to you. So today we're going to talk about plan operations and your fiduciary responsibility relating to operating your defined contribution plan. My name is Brian Montanez. I'm a principal at the firm and a consultant here in the East Bay of San Francisco.
And Breon Rollins, and nice to meet you all, those of you. I see some familiar names in the group, so appreciate you all joining us. If we haven't met, Breon Rollins, a consultant in the Houston, Texas area.
So just a brief blurb on who we are, Molten Noma Group. Molten Noma Group is an institutional retirement plan consulting and fiduciary investment advisory firm. We are an employee-owned shop. We take no revenue from any third parties, not even a cup of coffee from vendors when we sit to meet with them. We manage, as of the end of the last year, about 161 plans for about 25 billion in assets under advisement. There are 9 of us scattered around the country. And it is important to us to communicate that we are a fee-only investment consulting firm. We don't take any third-party revenue from any third parties. We send our clients invoices and we provide services, and that is our entire economic relationship with our clients. B.
Yeah, no, thank you so much for that introduction. And to get us started, provide some context on what we're doing today. A part of our fiduciary training program is we make sure that we're following some guidelines that the Department of Labor has outlined to require employers to educate their committee members on their roles and responsibilities of being a fiduciary in the plan. And if you see on the left side of the screen, we've got level 1, 2, and 3. So just to give you some brief background on how this process typically would work, our level 1 process that you see there grayed out is really the fundamentals of what being a fiduciary is, like understanding exactly what that means, how and why we are fiduciaries of plans, and really that basics piece that we have there in our level 1. Let me skip down to level 2 or level 3 for a moment. That might be where we're digging more into specific details. For some of you who are familiar with the process on the call today, we might be talking about common fee models or investments, just different details that dig right into the plan. And then for the purposes of today's presentation that Brian and I will go through, our level 2 is really those core areas of responsibility. And one of the core areas of responsibility would be those operational aspects of the retirement plan. So we'll talk about some concepts associated with that. We'll also go through the day-to-day requirements of running the plan. We're fully aware that you all have other responsibilities outside of what happens with the retirement plan, but there are some day-to-day things that need to happen. And then at the end of it, there are some requirement government filings or details that need to be shared with the Department of Labor or the IRS to show that the plan is running in a fashionable way. So this would be a part of a broader program that we will do. So Brian and I just kind of took out an excerpt today to discuss the operational plans with you all. So to provide just some background on just plan operations in general, we understand that many of you have long-standing plans. Some of you may be considering starting a new plan. And really, we want to just break down the details on what we mean by plan operations. So we have here, upon starting a retirement plan sponsors can assume responsibilities related to plan operations. Now, as I mentioned in our caveat as we started, we understand that many of you have other responsibilities, like the retirement plan could be along with your healthcare responsibilities or your financial responsibilities at your organization. So oftentimes you may not have the bodies at your organization or the information that you needed. So most plan sponsors will retain a service provider to help facilitate accurate and timely completion of these plan operation related activities. And we'll talk through some of those activities as we go through the presentation today. While you can hire a service provider, and this is where we like to introduce the concept that we talk quite a bit with our plan sponsors, it would be our prudent process. We believe that everything that we do throughout our retirement process require some form of a prudent process to make sure that we're following all these guidelines or keeping ourselves accountable for completion of these activities, breaches of fiduciary duty, or monitoring our service providers. So let me give you just a little background on what our prudent process would look like. You, of course, in the beginning, we're gathering relevant info. We're talking about here on this slide, the ultimate accountability for completing activities related to plan operation is on the plan sponsor. So you need some relevant info. What does that look like? What exactly do I need to do as a plan sponsor to make sure that I'm not only holding ourselves accountable, but our plan sponsors accountable as well? We also look at, after you have that relevant info that you've gathered, maybe you're analyzing that information to make sure that you have no breaches of duty, as we have here on the next bullet. One of your primary responsibilities would be breaches of financial fiduciary duty. If there's a failure from the plan sponsor to operate the plan in accordance with the plan document, we need to be analyzing that information, making sure we're understanding where there may be a failure, where something may occur. And then at that time, we're meeting and making some decisions. We might talk about, hey, we need a service provider here, or we need some support there. We need to monitor this service provider a bit differently to make sure that we're all in line with what we plan to do for our retirement plan. And then lastly, and probably the most important that happens throughout all of this process, we need to document this process. So yes, plan operations are important. There's some day-to-day things that are happening, but we feel like following a process throughout that will assist you in when you outsource, or if you're doing everything internal, you want to monitor, have some form of process in place to make sure that all of those operations are happening in accordance to the plan document. So Brian, I've got a quick question for you, as I just shared a lot with the group there. But has there been things that you may have seen before that could have been a breach of fiduciary duty, or something that you've uncovered as you've worked with some of your plan sponsors?
Yeah, I mean, the number one issue that I see personally, and you'll see, surveys out there or headlines that talk about the top issue. It's always definition of compensation.
Yeah.
So what the plan document says is or is excluded has to be administered correctly, and that's not something I can really help my clients with, other than to point out that, hey, you have to make sure you're doing this right. And one of my clients, when we did our plan document restatement, I had suggested that they go back and review their definition of compensation in their payroll, because we were changing the plan document. And they said, well, we have 184 different payroll codes. I said, now I really suggest that you go back and check your definition of compensation.
Yeah.
But yeah, that's probably the number one thing you'll see across all retirement plans, is that definition of compensation and what you have included and excluded from the plan.
No, definitely. Yeah. Compensation is definitely one of those items that makes its way, that needs to be constantly looked at, constantly monitored, because organizations change. Sometimes you merge in a new organization that had a different way of looking at compensation. Maybe there's some differences in the plan documents. There's a variety of things that can happen. So we'll completely agree. Definition of compensation is something that I've seen often as well.
Yeah, and practically speaking, I've seen a bunch of clients get COVID bonuses, right?
Yeah.
So, okay, how are you classifying that, and is that included or excluded?
Yeah.
Fun stuff.
Completely agree. Yeah.
Participation. So who can participate in the plan? So it has to be written in the document, and it has to be administered the way the document says, no special circumstances. So whatever the participation is, you have to abide by that. Now, some times you can make a retroactive amendment to expand the benefit to include more people. You can make a prospective amendment to eliminate some of the benefits, but whatever the document says is what you have to do. So by all means, please understand what your document says about participation. And the type of plan that you have will either have requirements for inclusion or flexibility for exclusion. So if you worked with a governmental 457 or a for-profit 401k or a nonprofit 403b, they're all going to have slightly different eligibility rules in terms of who can and who cannot participate, and who may not be excluded. But the ultimate answer comes down to what your document says in terms of eligibility. And these rules are actually starting to come together. So the Secure Act that was passed over Christmas, they had a part-time employee rule, and that part-time employee rule takes effect in 2025, and that's going to further restrict who can be excluded from salary deferral plans. So you're gonna have to do a look back over the past couple of years and check the hours that they worked. And if they meet a couple requirements, you will not be allowed to exclude them in 2025. So sometime in late 2024, absolutely recommend that everybody stop and go back and look at their eligibility and look at the hours and see who can and can't be included. Also, careful with rehires. The joke in the retirement plan industry is never rehire anyone. And we say that because it can be very difficult to go back and see, hey, have they already met eligibility? Where are they on vesting? And depending on what your document says about that benefit, they may come back in fully vested and immediately eligible, or they may have to start over. So keep in mind, there are generally 4 gates or 4 doors that people have to go through to keep retirement plan money. The first one is eligibility, right? Are they eligible? Are they in an eligible class? And salary deferral and employer contributions can have different eligibility provisions. So are they eligible? And then when do they enter the plan? Do they enter it on the first of the month, the first of the quarter, first of the year, whatever it might be? You have to go back and look at that entry date. And the third one is allocation. So if you think about a general idea of a profit sharing plan, right? The company has to evaluate the profits. So they have to have their financials closed. And then after the plan year, they'll look back and say, okay, we're going to contribute X amount of dollars. Well, often you'll see a last day rule, meaning the employee had to be employed on the last day of the plan year to earn their allocation of that profit. And then fourth, vesting, right? If you're not vested, doesn't matter how much money's in there, you don't get access to it. So vesting. So the 4 doors are eligibility, entry, allocation, and vesting. And then you have to be very, very careful in terms of employees coming and going and or switching from job classification to job classification. So depending on what your document says about eligibility and or employer contributions, certain people may be excluded because they don't work enough hours. Certain people may be excluded because they're in a different class of employee, or more simply, they've now hit a tenure level where they now qualify for a higher level of benefit. So you have to go back and look at, have there been any changes in their work hours? Have there been any changes in their job classification? Because they may no longer qualify for that benefit, or they may now qualify for a higher benefit, depending on what your plan benefits say. Along that line, contributions. So contributions also have to be spelled out in the document. The document may say it is discretionary, which gives the employer more discretion in terms of how much they want to contribute. But once the participant becomes eligible for a plan, participants may be eligible to make contributions from their compensation and or receive employer. Different eligibility provisions are allowed for those different sources, right? My money, the contributions coming from the employer, so my money or my company's money. But it all has to be written out in the document in terms of who's eligible and what benefit they are. And then keep in mind, if you are subject, well, that's an incorrect statement. If you're a nonprofit organization, except for a church plan, if you're a for-profit organization, you do have non-discrimination testing. If you're a governmental entity, no non-discrimination testing. If you're a church plan, maybe you have IRS non-discrimination testing, but the key here is non-discrimination is IRS. So if you are exempt from ERISA, remember there's IRS, it's a different governing body. We're going to talk more about non-discrimination testing in just a few minutes.
Definitely.
So remittance of contributions. So how quickly do you have to put it in? And we have these conversations all the time with clients. So employee money, so my salary deferral, that's my money. And the DOL does not want you holding on to my money. So the DOL has rules that say you have to make this contribution within a reasonable amount of time, or as soon as administratively feasible, or as soon as you've ever made that contribution. And if you go back and say, well, we're starting up a plan, or we have a new payroll company, we're not sure. Well, then the ultimate question is, how quickly can you make your federal tax deposits? Because that shows that you can segregate those monies. So employee money has to be done as soon as administratively possible. And a failure to remit those contributions in a timely manner is a prohibited transaction, because you are holding my money and you are potentially benefiting from my money. And that is a prohibited transaction under ERISA. But employer contributions are not my money until they're given to me. And in fact, we just talked about eligibility, entry, allocation, and vesting. So there's a couple doors I have to go through before that money really is mine. But the employer contributions, that is up to what you've decided, what you've put in practice, and most importantly, what your plan document says. So some plan documents say the contributions will be made with each payroll. Well, then you have an obligation because the IRS says you have to administer the document the way the document's written. So if your plan document says you will make the contribution, say your match, you'll match it with each payroll, then you have to make that contribution with each payroll. But if it doesn't say that, then you have until you file your 5,500, 9.5 months after the close of the plan year to make that contribution. Again, think about it in the way of a profit sharing plan, right? We at Multnomah Group get a percentage of our profits contributed to the retirement plan. You have to close out your fiscal year before you can calculate what those profits are. So depending on what your document says, you may have to make those employer contributions with each payroll, or you may have until you file your 5,500 for that plan year. And by all means, folks, please, we'd love to hear questions if you have any.
Yeah, definitely.
Yeah.
And maybe to piggyback off of a few things that Brian mentioned, he alluded to vesting earlier in some of his comments. And while we talk these terms quite a bit, and of course it's easy for us because we're in this on a day-to-day basis, but vesting essentially means ownership, that the individual owns the dollars that have been put into his or her account in the actual plan year. So there are two different types of vesting, of course, or two different types of contributions, I would say, that could lead to a vesting situation. And we have here in bold, because we want to make this clear, as Brian was talking about, when you're making those contributions as soon as administratively possible, those employee contributions for sure are always 100% vested. If an employee is deferring salary to put that into the retirement plan, that is their personal contribution, that is 100% vested at the time. Now, the plan sponsor, you all may elect to make contributions as an employer, and that can be subject to a vesting schedule. So we did want to identify the difference between an employee contribution versus what happens at the employer level. And there's really three different types of vesting schedules that we would typically see in a plan document. Now, there are different ways that it can be done, but these would typically be the three that we would see as we review plans and see what's inside of those. Immediate vesting would be as soon as those dollars hit the account, contributions are owned by the participant as soon as it's made by the employer. So to Brian's point, if it's a, let's say it's a profit sharing situation and it's subject to no vesting, but as soon as the dollars are paid into an account on behalf of the employer to the employee, those monies would be immediately vested. That employee could do what they would do as they would, leave the organization, et cetera. They would have no restrictions as it relates to those dollars. Cliff vesting is probably something we see often as well, where a participant becomes vested after an attainment period of a time specified in the plan document. So some of you may be familiar with language like a 3-year cliff period. So right after that day, after you've made your 3 years of employment or eligible employment for the organization, all dollars that have been contributed by the employer on your behalf into your account are now your dollars. You have ownership over that money. You have cliff vested into the plan. 1-year cliff vesting, 3-year cliff vesting, not uncommon for us to see in plan documents. And then a third form would be more of a graded type vesting, where you see a gradual increase in your ownership over a period of time for the longer you've been employed. So for example, a 6-year graduated vesting schedule is not uncommon. The first year you may receive 20% going out until you have the full 100% of the dollars within the plan. And again, we don't say that any of these would be right and or wrong. Brian, I'll throw it to you. Is there any one that you see more common, or would you say that across the group that you work with, you see a little bit of everything?
It's interesting. So I work with a lot of nonprofits and then for-profit entities, and they have different philosophies. So what I'm seeing in the for-profit world is, yeah, a much longer graded vesting, 4 years, 5 years, something like that, occasionally the 3-year cliff. But for the nonprofits, it's much shorter, either immediate vesting or 1 or 2 years. And coming out of the 08, 09 financial crisis, my clients and then, other folks that I know who also work with nonprofits, we've seen them start to add vesting schedules. So instead of it being a 100% vested, right, well, maybe we should put a year or 2 vesting schedule on it. But there's some recent research that shows that having a vesting schedule, especially a longer vesting schedule, doesn't necessarily do what people think. There's hey, we want to put a vesting schedule on to retain people. Well, some of that recent research shows that someone may hang around for a couple more weeks, short-term itis to get that vesting, which is not in your best interest. But the reality is they're going to leave and they're going to get a higher salary, so they're just going to forfeit it. And the opposite is true, which is if you have no vesting, research shows that that's actually more of a valuable retention tool, it's more of a valuable attraction tool than a vesting is as a retention tool. So having a short or no vesting window has shown to be a benefit that employees or potential employees are looking for, whereas that longer vesting schedule doesn't necessarily do what people are thinking. So I know that was a very long-winded answer, and there are a couple clients of mine on the call, and they're just like, yeah, that's typical, Brian.
Exactly what we needed there, because what you're speaking to several of the plan sponsors on the call today, there are competing priorities when you're building these plans. There are competing priorities when you're determining, is this more for attraction for employees, maybe as we're recruiting? What does it look like if we include this detail as a recruitment tool? Or are we need to retain XYZ? What do we need to have as a part of our benefits or our retirement structure that allows for us to retain more employees? So again, these are not easy decisions, oftentimes, to your point. And really it's following this prudent process that we'll come back to throughout this presentation, that even as you're looking at what the retirement plan will include, that process needs to be in place, because you always want to document the reason why you made decisions. Well, we made this decision because, to Brian's point, hey, as a nonprofit organization, it made more sense for us to add this 1 year because of XYZ. Being able to document, have that information why you made that decision is really a part of a holistic process of being a retirement plan sponsor. So, and if we jump to the next slide, Brian, we could talk about now what happens when someone doesn't vest, because that is a common thing. And one conversation that we'll have here in a bit, as we allude to some things that are happening with the Secure Act, is that oftentimes you'll have employees who they'll leave the organization before they have ownership. Again, let's go back to that word from our previous slide, before they have ownership in the dollars that have been contributing on their behalf. So we're not talking about any of the employee contributions that they've made. This would be the employer portion. So if a participant leaves prior to attaining the full vesting, that unvested contribution typically is associated and returned into what we would call a forfeiture account within the plan. Now, the plan document has to specify what the use of forfeitures can be done, how you can use those dollars. Generally, we have a slide here, and there's been some updated guidance that we'll talk about here in a moment, where forfeitures can be used for a few things. Offset employer contributions. Hey, we've got this bucket of money that we had already paid in as an employer. We're going to reallocate that towards employer contributions on X date. Pay reasonable plan expenses that can be deemed reasonable. But we'll talk about the difference here on our tip from the revenue credit account versus the forfeiture account. And then maybe also reallocate additional employer contributions. There may be a time where these dollars are here, they were already allocated for the retirement plan. You may be able to do an additional employer contribution, add those dollars separately. But there is a difference. The forfeiture account is different from the revenue credit account that some of you all may be familiar with as well. And to give you just a little breakdown between the two, forfeiture account, again, we're going to talk about ownership. Employees who have left the organization that had not vested, dollars paid into by the employer, that is still money owned by the employer. Revenue credit account is slightly different, where some of you may have investments within your investment menu or investment products that share revenue back to the retirement plan in basis on their cost, how they're set up. There may be a structure of a certain expense ratio that they have and some form of revenue sharing back to the plan sponsor. And in that event, there will be a separate account set up where those dollars from that revenue sharing, and that would be your revenue credit account. Those are two different things. They can be allocated towards two different things. So we want to make sure that there is a distinct difference between the revenue credit account and that forfeiture account. So we have seen some recent guidance that I just want to share briefly. And Brian, any additional details you want to add here? And this guidance is just as of the last few weeks. So of course, as you all know, the retirement space is constantly evolving. I remember just a few years ago, we were talking about Secure Act. Then we had CARES Act. Now we're at Secure Act 2.0. And there's often something changing, often amendments being done. And the most recent regulation related to forfeiture accounts is on or after January 1, 2024. There's some more guidance around when forfeitures should be used and how they can be used. So the proposed regulation indicates that forfeitures can be used for some additional following reasons. Of course, we've got pay plan administrative expenses, reduce employer contributions, as we've mentioned here, or increase benefits, as we've talked about here, add additional employer contributions. But one thing that has changed is that under this regulation, forfeitures must be used now, or proposed regulation must be used now no later than 12 months after the close of the plan year in which the forfeiture is incurred. So that gives just a bit more guidance on how timely that forfeiture account needs to be used. Those balances need to be drawn down. And it's really just to help to ease some administrative burden, simplify some of the administration that we've seen in the past. So Brian, any thoughts there on any of the new proposed regulations?
Yeah, you stole my thunder. That's thanks to our friend Louis Labrandy for that information. But one comment for the audience. So Bria and I, with our clients, we put these working groups together where we dig into the daily administration. And last fourth quarter, I found multiple clients that had real money in their forfeiture account because they had not been checking it. And they were not aware that the money was put in that forfeiture account. So last fall, I made several CFOs happy by coming back and saying, we found X amount of dollars in your forfeiture account. And they're like, what? So yeah, starting next year, it's likely going to be a slightly different regulation. But for the finance people, right now, finance people are probably typing up emails to their benefits person saying, hey, do we have any money in our forfeiture account?
I can see it now. Yes.
Yeah.
Definitely.
Yeah.
And that revenue credit account also, I know we're not necessarily discussing this today, but many of you may be in a situation where there probably is already something structured for you that you're not aware of, or aware of it and not exactly how to use it. So feel free, if you've got a question. I think we do have a Q&A question in here that maybe I can answer in real time. We have one that has a question around being a new member of a retirement plan investment committee. Maybe we can defer that one to the end of our presentation. But we do have one right now that is related to, is the forfeiture account usage only related to 401k accounts, or do 403b accounts also have those? So Brian, maybe I'll throw that to you. Does a 403b plan have forfeiture accounts also?
Yeah, absolutely. So any plan that has employer contributions, it could be a 403b, it can be a 401k, it can be a 401a, and then there's a couple others out there, 415s and 414s. That are employer contributions only. But yeah, if there's an employer contribution into the money, into the plan, then you can have a forfeiture account, because again, if someone doesn't make full vesting, then they forfeit that amount. I mean, the requirement to use within 12 months. Yeah, it's a proposed IRS regulation, so it would be applicable to all plans, because the IRS has, except for certain church plans, the IRS has purview over all plans. As a new member of our retirement plan investment committee, what should I expect my onboarding experience to look like? I'm sorry, it's written anonymous. I don't know. I know what we do. We do a
so Brian,
review.
I was thinking maybe we hold that one to the end, because we can talk through. If you recall, I know we've got the piece where we'll talk through some of our fiduciary training calendar.
Okay.
Maybe we can hold that towards the end, and then we can wrap that one up. But let me know your thoughts. What do you think?
Yeah, sure. I'm with you. All right. So moving on with the slides. So distributing benefits. So again, plan document has to say what it is. No sympathetic circumstances, and I do see sympathetic circumstances when it comes to hardships and or loans, which is, oh, but this person really has a problem. You know, we can try to amend the plan document if your committee or if your board or whoever's in charge of the plan is willing to do so. But generally speaking, what the document says is the only benefit you can have. Three common types: lump sum, right? I terminate, I retire, give me my money, I'm going to an IRA or to a new employer. A rollout, which would be I'm going to roll the money over and protect it tax-free. So a distribution is fully taxable, and depending on how old you are, maybe state and federal penalties. A rollover moves money from one qualified investment to another qualified investment, so another 401k, a 403b, an IRA, and protects the tax status and protects it from taxation for distributions. Or annuitize, and there's a lot of talk out there in the world right now about annuitization. Those are common. I would add a fourth, which would be some sort of a systematic withdrawal, which is, hey, give me something, give me $5,000 a month, whatever the math might be. But if you can think of it, it's probably available, but it has to be written down in the plan document before you can execute on it. And generally speaking, you don't have to let anybody take their money out. So until they reach normal retirement age, generally speaking, you don't have to allow them to take out a lump sum or annuitize or roll it over prior to that age. So it depends on what your document says and depends on what your goals are. But distributing benefits has to be written in that plan document. Non-discrimination, oh boy, one of my favorites, non-discrimination testing. So again, unless you're a governmental entity or a steeple church, you're going to have non-discrimination testing requirements because it's IRS. So even my qualified church control organization clients, my 401k clients, regardless of type of contribution, there is non-discrimination testing required. Now, generally, non-discrimination testing is, and if there's anybody that knows this stuff in detail, you're going to know why I just emphasize generally. You take the average benefit of a highly compensated employee as defined by the IRS and the average benefit of the non-highly compensated employees. And those ratios have to be compared to each other to make sure that the highly compensated as a class are not benefiting more than a de minimis amount over the non-highlies. Now, that could be something like the match. What percentage of a match did the highly compensated get? What percentage did the non-highly compensated get? Or it can be the availability of a benefit, right? The 5% contribution, the 7% contribution, and the 9% contribution. Are all of those three contributions available to a non-discriminatory class of employee? And depending on what you have done in practice, depending on what your demographics are, you may pass non-discrimination testing or you may fail non-discrimination testing. So failing non-discrimination testing isn't a death knell. There are common remedies, such as return contributions from that highly compensated employee or restrict benefits from that highly compensated employee so that that ratio drops, or increase the benefits to the non-highly, such as give them more money or give them access to another class of benefit. So bring down the top level or bring up the bottom level until those ratios pass. And then there are some clients that just plan to fail, which is fine. You have generally 2.5 months after the plan year to correct things without any penalties. So some clients every January, every February for their calendar year plans, they promptly do their non-discrimination testing, figure out how much they failed by, and then take immediate actions to pass it. And that's okay. There's no real penalties as in IRS or DOL penalties for failing non-discrimination testing. The problem comes if you don't correct the non-discrimination testing. So you can return excess contributions, you can bring non-highly compensated up to a certain level, or you can just plan to fail and then plan to take immediate corrective actions after that. But again, comes down to what you've written in your document, because that's the benefit you have to administer, and then the demographics of your organization. So you may need to amend your document to have a more testing friendly benefit or plan to fail.
And Brian, we did get a few questions here. Maybe the first was related to the comments around normal retirement age. You know, what is the importance of normal retirement age? Is it possible that it could be 62 or 65 without affecting plan administrative or benefits? What are some of your thoughts there?
Yeah, so the significance of normal retirement age are vast, actually. In this context, it is a distributable event. So when you hit normal retirement age, whether you're employed, whether you're not employed, that is a distributable event, so people can get their money out. There are other issues such as vesting. If you hire an older person who's closer to normal retirement age, there are rules on how fast you must vest them. But from my point today, it's a distributable event.
Yep, and the maybe just to piggyback off that distributable event, the next question was around how might a reduction in force impact this as well. That is also a distributable event. When you have a reduction in force, that is included in all of your testing scenarios. So depending upon where the reductions came from, you could definitely end up skewing numbers one way or the other, because this would be considered a distributable event also. In any other context there, Brian?
Yeah, so the reduction in force and non-discrimination testing are two separate issues, but directly affect each other. So what I mean by that is, what is a reduction in force? A reduction in force is when you have significant layoffs, 20% or more of your population. That's a reduction in force. That population that has been let go has to be fully vested, and Brian did a nice job of explaining what vesting is. And the problem can be that you're going to let go lower paid employees, right? You keep your senior executives and let go of your staff, and that could skew non-discrimination testing the next year, because non-discrimination testing is a plan year issue based on the actual demographics and actual participation. So if I have a reduction in force and I get rid of a bunch of non-highly compensated employees, I could have problems with testing the next year, because who's left? Highly compensated employees, and I could have a non-discrimination testing issue. So if you do have a reduction in force and you do remove non-highly compensated employees, again, the IRS defines what it is. You might want to be careful about your non-discrimination testing, especially if you were barely passing in the past.
Definitely. Yeah, that last comment is probably the key. If you've been barely passing before and go through a reduction in force, you probably really want to identify what that group is and how it may impact. So yeah, definitely agree there.
Yeah.
Okay. So a couple of the items that we mentioned before that really fall under, these are reporting to the agencies, things that we have to do. These are must do's if you're a retirement plan sponsor. Of course, a third party or a service provider can support you in this, but these are just items that need to be done on an annual basis. First, many of you are all familiar with this. Probably the most familiar that everyone talks about would be that Form 5500. Your Form 5500, it's that annual tax filing. It basically just shows all of the details that include what's happening with your retirement plan, your employer information, your participant accounts, asset holdings and performance, fees paid. There's going to be some questions about your plan operation. Really what this is allowing is for us, you can look at the plan, number of participants, the type of investments that are in the plan, and just, statements around if the plan is forming its function as a retirement plan. So that Form 5500 is sent jointly to the IRS and the Department of Labor on an annual basis. Your Form 1099-R, that's more of an individual thing. That would be, for example, if you or participants within your plan take a distribution during that plan year, that report is sent to the participants in January of the following year, allowing their tax situation, tax preparers to account for any withholdings that took place at the time of the distribution. Many of you might be familiar with, if you take a distribution prior to the age 59 and a half, or terminate and don't roll those dollars over, you could be subject, one, to a penalty that is included for taking that distribution before retirement age, but also there could be some additional taxes required as well. So that Form 1099-R is what outlines that detail and is shared with the individual participants at the time. And then lastly would be the 8955 or SSA, which really reports terminated participants with vested benefits to the IRS. And I'll pause there, and Brian, please jump in, because one thing that we talk quite a bit about with some of our plan sponsors will be really the conversation around missing and or lost participants. Participants that may have a balance with you that is vested. You may have lost their information. People change address, they move, they go to different jobs, and they have these vested balances at the organization. That Form 8955 is a report that is sent that has who would be included as a part of the group that has a vested benefit. And Brian, any additional context there that you want to add on the 8955?
Yeah, sure. So it's a little bit of a pain. So SSA, Social Security Administration. So the Social Security Administration wants to know if an employee, a participant, has left money behind in your plan, so that when they go to file for Social Security, the Social Security Administration will say, "Hey, Brian, you realize you left some money at Multnomah Group way back when." This can be a little bit of a problem because it's a one-directional communication, as in the plan tells Social Security Administration that you left and have money, but they never tell the Social Security Administration that you took your money out. So what happens is somebody goes out and gets this, what I like to call a maybe letter, because the first sentence says, you may have money at Multnomah Group or whatever your former employer is. And I've seen some pretty nasty documents with marked up and sent to, the CFO or CEO, whoever it might be. Hang in there. Let's go back to your record keeper. And this next part goes back to record retention, right? So
Yeah.
Right now, some of my clients are about to say, yeah, we know what you're going to say, Brian, never throw anything away. Right, Eileen? Right. So never throw anything away, especially in the digital world, because you'll always be required to prove a benefit. So the easiest way is, hopefully the first way, is that the record keeper you're working with has a distribution form signed and showing them that they took a distribution. And I've actually had one, I thought 17 years was pretty impressive. And one of my clients at one point said, yeah, how about 27 years? They had an employee who was terminated 27 years prior get that Social Security maybe letter and come back and say, hey, you owe me money. And fortunately, they were able to find the distribution form and show the participant, no, you took your money out many, many, many years ago. So
I couldn't imagine. I could not. 27 years.
27. Yeah. So when you get that letter, don't freak out. Let's find out where the record keeper is and let's get that proof of distribution.
No, definitely. No, thank you. And so we do have a question around, I kind of alluded to missing participants, et cetera. Do we have any techniques for finding? Brian, what are your thoughts there on techniques for finding missing participants?
Yeah. So the DOL is actually, so a couple issues. One, what is your responsibility? And then the techniques, right?
Yeah.
So the DOL has come out very clearly and said you have a fiduciary duty to attempt to find missing participants. And if you just type into your search bar, DOL missing participants guidance, you'll get it. It's very clear. So you have a fiduciary obligation to attempt to find them, not to actually find them. But there's about 5 things that they say that you should be looking at. Techniques, though. So outside of what the DOL is saying, well, and in conjunction with the DOL is saying, talk to friends at the office, right? Who might know that person, and beneficiaries. If anybody's going to know where someone is, it's going to be someone that has a financial interest in them. But yeah, there's Google searches. There are paid search services. Yeah. Your record keeper will most likely have a paid search service, and it might be, $25, $30. But if you can find some of these participants, it makes your life a whole lot easier. But exit interviews, right? Make sure you have valid contact information, preferably an email, because we change our physical addresses, but very rarely change our emails. So an exit interview to make sure that they have that information on the way out the door. Your record keeper will have a variety of resources to find local lost participants. And in my experience, it's been relatively inexpensive. but there are just some participants that don't want to be found and you can't be found. So document the effort that you went through to find those participants and move on with your day.
Yep, my comment was going to be exactly back to that prudent process. If you have documented the process that you take to attempt to find missing or lost participants, whether it's working with the record keeper, internal sources, et cetera, being able to document that process will greatly benefit you in the event if someone comes back and says, hey, no one was looking for me. No one tried to find me. And we have a winner, Brian. Did you read that?
I did.
That they had to question a distribution from 1989. So we have a winner past the 27-year mark, 1989. I couldn't imagine.
Right.
I could not imagine. So
thank you, Janae. That was awesome.
But no, that's good. So a couple quick things as we wrap before we head to questions. These are some of the details that you have to do. Compliance is a big piece of that. But I'll briefly go through this slide just to say again, having that prudent process in place, documenting, having your ability to analyze, making decisions, finding all of those key results will greatly benefit you because there are a large number of requirements. We are fully aware that as plan sponsors, you have other competing priorities. Being able to maintain a retirement plan, one, is a challenge, but two, making sure that you follow all those compliance items end up being an additional challenge. But the key that we would like to say here is that errors discovered proactively by you as the plan sponsor or the committee will always be preferred than errors found by the Department of Labor or the Internal Revenue Service. So if you have an independent third-party auditor that comes in and looks at your plan on an annual basis, finds those items with you internally, you are able to go through processes, the self-corrective procedures with the IRS and Department of Labor, versus having an engagement from the Department of Labor or IRS coming in, because at that point, penalties, fines, potential dissolution of plan, there could be a variety of things that happen once we get to those steps. So our goal would be use those structured corrective programs, aid plan sponsors if you have any issues. But again, legal compliance and disclosure requirements, as long as those are all being met, you'll be in a good position. But if you do have an error, be proactive. Let's find it first before we have to work with the Department of Labor or IRS.
Very good. Thanks. So our final plan slide is audits. So large plan sponsors, meaning generally 100 eligible participants or more, have to have an audit where an independent auditor is going to come in. And that auditor is going to come in and they're going to dig through your shorts. They're looking for fraud. They're looking for security of assets. They're looking for internal controls over those issues. And they're looking to make sure you're administering the plan in accordance with the plan document. But keep in mind, they're only doing sample testing. So they're not going to catch everything. In fact, one of my clients had, I think it was 7 years where they were calculating the employer contribution incorrectly and the auditor never caught it. The auditor never got onto, from a sampling perspective, a participant that was affected. Kind of amazing, but it does happen. They are a little painful. They're going to take a couple weeks of your time. They are required by law. So you're going to have to go through your audit. And then when your audit is complete, the auditor will give you an AUC 260 or a report to those charged with governance. It's the actual name, report to those charged with governance. This is going to summarize what the auditor found. If they have any observations, if they have any deficiencies, if they have any control concerns, they're going to document it. So at an absolute minimum, when you're done with your audit, read the AUC 260, report to those charged with governance. And if you don't want to read the whole thing, that's fine. Just go to the observation section and they will say, yeah. And they will say, no issues, no issues, no issues, or they will document what the exact issues are. And by absolutely, you have to immediately take that seriously and go out and fix not only the error that occurred for your participants, but the internal control that was deficient. So if you made a particular mistake on a participant's account, you have to go positively affect that participant's account. But you also have to go back and document that internal control change to prevent that from happening. And then fraud evaluation, right? Clearly, fraud evaluation. We have bonds for them. They're required by law. but fraud evaluation, right? Who handles, who's got their hands on the money? The finance team. So the auditors want to make sure that you have internal controls and checks and balances to prevent fraud. It is a painful effort for clients to go through, but getting a clean audit is a really nice thing because it shows that you're operating your plan not only in compliance with the plan document, but that you have good financial internal controls. So it's a feather in your cap.
Oh, definitely. So
we have a few minutes.
We do have the one question, and Brian, we had started answering, and the reason why I propose maybe we hold it towards the end. It says, as a new retirement investment or retirement plan investment committee, what should I expect from our onboarding experience? So Brian, I know you were starting to answer, and I'm gonna throw it to you, but I would say that as we can't speak to all organizations or details of how that works, but a part of that process would be back to, as I led the discussion in the beginning, our fiduciary training calendar and our fiduciary training program. And then also details that we include in each. And presentations similar to this are a part of that process to onboard new committee members to make sure that they're comfortable and have a full understanding in what their fiduciary responsibility is to the plan. Brian, what would you like to add that's firm specific for us as it relates to how we do things?
Well, I would simply say, as a new committee member, you need to go out and read the governance documents, right? Is there a charter delegating responsibility to you? What type of delegation? What is your responsibility? What liability do you have? So understand first and foremost what your role is and what responsibilities and liabilities you have. That should all be spelled out in a charter. If it's not, give us a call, talk to your board, talk to your whoever's in charge.
Yeah.
I would also say go back and read the past couple minutes to get a better understanding of what the committee has been doing, what the topics that they're working on, so that you understand where the committee is from day one. And minutes are fairly quick, right? Maybe it takes you 10, 15 minutes to read a couple series of minutes, but that can be 2-3 quarters worth of information bringing you up to speed. Understand your investment contracts, who has the liability, what responsibility, what authority you have, where those investments are. Are there any legacy assets? Time and time again, we'll find, oh, somebody left an account back behind somewhere. So understand your authority, understand your responsibility towards those investments, and the fees, right? Have a good understanding of how fees are calculated, what the contract says, how they're allocated, who pays them. Because funds and fees are the #1 issues that you see in litigation, and then plan operation is really an IRS or DOL side. But understand, what your authority is, what your responsibility is, what your liability is, how you're empowered, what that committee has been doing in the past, so that you understand what their practices have been and you understand what their current concerns are. Understand the investment contract, so you understand what your authority is, and have a really good understanding of how fees are handled. So that is what we do with clients when we onboard a new committee member. And I think you're all probably saying that makes sense. You just hadn't thought it through. But that's what we would suggest as a new committee member.
Yeah, no, definitely. So any other questions? I know that we've got a few minutes remaining on our time. Of course, Brian and I really appreciate you all spending this time with us this afternoon. Any additional questions? All right. I mean, Brian, it just seems like we've done a stellar job at this point. There's no more questions. I mean, what are your thoughts, Brian? Any final thoughts?
Hey, Brian, we did have one more question that just popped up.
Hey, perfect. Oh, do we have an audit checklist for plans?
I don't have an audit checklist, but if you wanted to pop me an email, I'd be happy to find something for you. There's plenty of them. But pop me an email and I'll do a little legwork for you. No problem.
Yeah, that'll be something that we can definitely take offline and share as a resource. Both the two questions that we had were related to audit checklists, so we can definitely do that offline. Yeah.
Okay, great.
Yep.
With that, I give you the gift of time.
Yes.
Well, wait, Victoria, do you?
They got 5 minutes. They got 5 minutes back in their day, so we did good. Look, Brian and I like to talk. So to getting it to 12:55, this is a win. So we did a good job. So, thank you all so much. We really appreciate
Well,
you all.
hold on, there's that one question. Do you still see a lot of misuse in the QDIA not following a proper disclosure and operational guidance? Yes.
Yes.
Until we get on board,
Yeah.
because we actually do a detailed review of all the notices and disclosure obligations. Yes, I often, unfortunately,
Yes.
often is the right word, see that people are not making the required notices and disclosures either upon hire or on an annual basis, just because they're not aware of it. And most record keepers will say, "Yeah, we'll do that for you, but you have to initiate it, right? Each year you have to log in, and they'll mechanically distribute it, but it's on you to initiate that disclosure."
No,
Especially with conversions and M&A,
common.
yeah.
Yeah, definitely common. Yeah. Okay. Now it's 4 minutes. So we got 4 minutes.
Less of a
But
gift.
we appreciate the questions, the interaction. This is definitely valuable for us and hopefully valuable for you all as well. So thank you all so much.
Bye, everybody.